Hi guys, 18 July 2023, Tuesday, MAO with Kel. Now, bears are throwing in the towers. Well, apparently, look at it. The bears are really being hammered by the bulls right now. And even Yardeni, right, he was so bearish early part of this year, has turned to bull, all right? And he's aiming at 5,400, I think. This is getting a bit absurd, right? And of course, the banks are now upgrading all the tech shares and expecting to go higher. I'm just thinking out loud, if the banks are able to predict the technology shares going much higher, why don't they just save themselves? Well, all these details coming up, let's go into the content, all right? So disclaimer apply as usual, and thank you, Ames, for the kind sponsorship. Now, remember what I said last night, yesterday on the MAO, right? I was telling you that Tom Lee is very bullish while Mike Wilson was bearish. So who you root for, right? Apparently, the people are telling me that they're rooting for Tom Lee right now because everyone believes that the S&P will see 5,000 by the end of the year. Wow, this is amazing. Now, think about this. At the start of the year, everyone was looking at 3,400 to even 4,000. I mean, 3,004 to even 2,005. But suddenly, everybody is looking at 5,000 now. So the thing is this, whether or not who's be right, that you had to make your own choice, okay? Because the thing is this, you must understand right now that he's being bullish because he believes that if there's no recession coming in, then the bullishness will continue, all right? Just take note of that. He did share something along that line, all right? So you have to take note, yeah? So the Credit Suisse Fear Barometer, which hardly see in the market, well, apparently you look back into history, you can see something very interesting. So the last time we saw it at a high level of 30, 31, that was where before the pandemic happened, okay? And of course, what you can see, what happened after that, wow, look at it. This is amazing, okay? So after that, we can see that the thing went higher, okay, in 2021. Then after that as well, right? We have the market pulling back in 2022, and of course, the same thing happened. So now where we are right now, we are still at the same point right now, and what do you think will happen pretty soon? So in case you don't know what is this is the new gauge from Credit Suisse back in 2009, right? It actually tracks the willingness of investors to pay out for the downside protection with collar trades on the S&P index, all right? So there's something to take note. So of course, where we are at the same level, one should be very careful, right? Indeed. So I like this joke itself, and I think it makes a lot of sense because everybody thinks that inflation is not printing the money itself. This causing inflation is not a big problem because as long as stock market is going well, everybody has thing to do. They are feeling it's okay, but obviously there will be a point they have to pay for it. So let's look what happened last night. Okay, the Dow Jones was up by 76 points, the NASDAQ up by 147 points, and because all the upgrades was ongoing. So basically, sorry, there's some PowerPoint issue. Okay, a minute on this. Okay, let me skip it. All right, so the stocks went higher as Wall Street embraced the quarterly reports from some of the biggest companies. And of course, we saw Apple, Tesla, JP Morgan all went up, right? Primarily because, right, we're going to have a very strong week this week on the Bank of America, Morgan Stanley, Goldman Sachs, all are coming out their earnings. And of course, we also expect from United Airlines, Las Vegas Sands, Tesla, and Netflix. So with all this thing coming out, or all this stock earnings coming out, what do you think will happen? Well, people is expecting a lower profit situation, and they actually have forecast that with 7% decline in S&P earnings just 1 year ago. But the thing is this, right now, people are saying that, nope, this is going to change. They believe that things will get better. So even though we have this Federal Reserve blackout period coming up, but still market is pricing in a 97% chance of a Fed increase of rates. So after that, people are buying that there'll be no more rate hike for the rest of the year. So with all these things, you can understand now why Ed Yardeni, the president of Yardeni Research, came out and said that the market's kind of overjoyed with this inflationary soft landing scenario, and he believed that right now, right, this is a rolling recession, not an economy-wide recession, but now he thinks that it's a rolling recovery. So basically, from a rolling recession, now it's a rolling recovery. So things have changed. All right, so let's take a look at what Yardeni has said. All right, Yardeni believes that this is going to be a new bull run, okay? He believed that the market can continue to go up higher. As a matter of fact, right, he's putting himself as benchmark to 4,800 to 5,400. Wow, that is about 6.5% to nearly 20% upside from the S&P of Friday close. So he believed that this is going to continue. He praised the US central bank for bringing down inflation effectively, and he feels that, right, this is going to really become a big bull. And in fact, he did leave something at the back. He said that he's just worried about a market correction in the near term after the hot rally this year. But he believed that this is going to be a civilized bull market. After a pullback, it should be going higher. So for his target right now, he's looking at 4,600 for this year. And this is like way higher than most of them who are looking at 4,255 from the Wall Street strategy. So what do you think? Let me know in the comment box. All right, the seasonal pattern actually shows that the July month for S&P will continue to go higher. Now, this is different from the NASDAQ, yeah? The NASDAQ do see pullback, but the S&P, the market apparently built based on the seasonal pattern for the last 20 years. They believe that the month of July will continue to go higher, all right, before a pullback in August. Then in September, a big rally, and a very incredible sell-off until mid-October. So what do you think? Do you think this will happen? Well, everybody got their own rights and things, but this is a seasonal pattern for the last 20 years. And of course, look at the current right now, the total market cap versus the GDP. This is Warren Buffett indicator. We are really at the high level now at 172. And this is considered high because the last time we see at 200%, the stock market in 2020 pulled back quite significantly for the entire year. Remember that? So now the thing is this, we are going back up again because you can see all along, this has been very cordially together side by side. But ever since 2011, when money was pumped in the system, the whole thing has had to change. So nonetheless, when the market's at 172, I cannot see myself from buying in the market. Right, so now the spread is the one, the spread between the 10-year and the 2 years. The spread is still at the lowest point since until 1985. So now we can see very clear every time where we have this spread coming down, it's just a matter of time, we will see recession. So of course, again, I've been saying that the broken recorder is that we know that it will happen. We know that by 2023 late or 2024 itself, this recession will come. But of course, the Wall Street now don't think so, and the market is still so strong right now. It's kind of difficult to believe in that. Okay, so but remember back in this 2023, Yellen says that there'll be no recession coming in. Remember, July she said that. Now the thing is that back in February, this 2008, Bernanke was also the Federal Reserve, also say he sees no recession, but we all know that after that, that was 3 months later, that was the start of the recession. So if you look at it right now, if things going to be like imprinting on this, then of course 3 months later will be October. Would that be happening for the US market? Well, let's see whether this will happen. So if you bring back you in a time, actually, right, the market peaked in 2007. A lot of people believe that it was 08, 09, the market sell off for Lehman crisis, but a lot of people forgot that it's actually 07 that led to the market historical high back then. So it's still repeating what happened in 87, 97, and 07. But the real selling came because in December 2007, that was where the market hit the 200 MA, couldn't go any higher, and that was where it led to the first sell-off, right? The S&P basically from 1,400 dropped all the way to 1,300, 1,250 in just a couple of days. And after that, the market did try to rebound. And when you retest the moving average again, but that was in May 19, all right, in 2008, that was it. That was how the S&P started to collapse all the way down until it went below 700. In fact, the low was 666, if I remember that. So think about this. Will this be happening again? Well, if you look back into the S&P 500 with the 200-day moving average, you can see that we are now very far away from the 200-day moving average. In fact, as we are 11% away. So do you think that it will happen? Well, first of all, I think the first thing it has to come down is to break below 44.50 first. Okay, this is 44.50 has to break because this is a two common point of the RSI. And this is where it leads right now. So if the market needs to pull back, it has to go below 4450. Now it's 4522, so about 70 points from where we are right now. Now, only if the market breaks 4450, then there's a very high possibility that we may see the market coming down to the 200-day moving average. But don't forget, it will move every single day. Now, what I want to focus is that I just kind of realized that the volume the last 7-8 days has been very scarily stable, or what can I put the word it's like it just mirror each other every day. It's like every day itself the volume has been so stable. It's like not really traded by any human being. In fact, itself is that every day the movement itself is like you buy, I sell, you sell, I buy. It's like the robot are trading it, and I don't like this movement. And because of that itself, I really think that you should just go slow. this week. Because remember, I've been saying this by 25th of July, my S&P 500 will have a KFC, which is a cow flip cycle. Likelihood there could be a possible big movement after that. So for me, if the market is going towards there heavily upside, then there is a small possibility that it could reverse instead. All right, so now I look at the federal government current tax receipt. Now, what is that? So basically, right, let me just show it to you now. Okay, hold on a minute. I tap too fast. Okay, so gross receipt can be referred to any gross excess taxes. It could be on a company gross revenue and stuff like that. So now what we can see over here is that yes, went below the negative zone. And of course, again and again, whenever you go to negative zone, that is whereby the recession will always happen. So now the thing is this is something that we can see very clear, that when this government current tax receipt start to go below water, that is where recession will kick in. So with what is happening right now, we are definitely below water. So that means that we are in recession. But the question is, why aren't we seeing that? Well, like I say again, the government have been doing a great job to maintain it. And of course, it's going to be very difficult. So for short sellers, you really need to wait for a time. It's not like, short the market and expect the best, because a lot of bulls are still buying. And until the market realizes that the buying, you last see the last ninth inning, then things will really happen. So there are 4 important charts for you to take a look. Now, this is the liquidity of versus the NASDAQ correlationship. You can see now the huge divergence between them. This is not a good sign. The central bank balance sheet versus the NASDAQ. So usually the balance sheet goes up, the NASDAQ goes up, we can understand. But now the balance sheet is coming down, but yet the NASDAQ is going up. This divergence itself is really, really incredible. And I can only tell you this, probably there's some hidden funds entering the market. But once they let go itself, the selling will come in. Now, the US retail sales contracting in nominal term, look at it. It has contracted to below the 0 mark. And the last time we saw this was back in COVID period, then the GFC, that is the global financial crisis, Iraq war, and the dot-com bubble back then. So which means right now that we are actually having problem, and sales is now down to negative zone. And of course, the June CPI likely to be the last for favorable year-on-year effect. You can see that again. They expect the CPI data to go back up again. And that's what I said yesterday, referring to you that I believe the next CPI data for next month will be higher than now, okay? And of course, the US labor market is weakening, but still no recession yet. Now, you can see that whenever the labor market is actually increasing, the job losers, job losers, you can see that is where recession will kick in. So where we are right now, we are having that. Again, with all this information, it's very clear, and this is not done by myself, it's done by Bank of America. So think about this. If they are all telling you that these are all happening, why aren't we looking to get out of the market? But again, there's so many people looking for buy. Every day you can see on YouTube, everybody calling for buy, value investment and stuff like that. What do you think? Now, for me myself, I'd rather stay out from this. I'm not interested to chase, but I'm interested to buy when the price comes down significantly, right? So you can see right now the Apple is being upgraded by, let me take a look. Okay, Morgan Stanley had just raised their price target for Apple from 190, which is now, to 220, and while maintaining its overweight rating. So meaning they expect further upside for Apple. And of course, the next counter is NVIDIA. Wow, look at it. Now, NVIDIA was trading at only less than 100 just like last year around all of this November period. And now from less than 100, it's now 400, it's up by 400%. So think about this. When was the last time we saw this? Yeah, it was Tesla. It was the same thing again. So those who shorted this counter is going to be so dead. Because see, once the market went below the MA 200, if you shorted it, it's fine. But once it goes above the MA 200, no matter what you tell me, it's a buy, it's a buy, it's a buy. And you can see right now it's surging higher. And of course, let's take a look who is giving an upgrade on this counter. Well, Citibank have just upgraded NVIDIA to $520 with maintaining its buys rating. Wow, this is really amazing. So what do you think, guys? What should we do? Now, to me, it's very simple. If now we have a lot of guys calling for buy and the price doesn't go up, usually the opposite will happen. Now, this is Meta. Meta hit a low of $90 back in November last year. And after that itself, look at it. It just go one single 45 degrees upside. Until today is 310. So it's again very clear that all the short sellers that were shorting in November all are totally frightened by the buy up, okay? And that's why now you can see the gap is about to cover. This is the gap, and I think it will be covering soon, about $320. So let's see how it goes. If it covers, I think that is the end. But of course, again, playing the devil advocate, usually when you're near to cover, the market will start to peak, all right? So Credit Suisse, okay, wow, Credit Suisse, they have, I mean, you should say themselves, yeah? Credit Suisse has just raised their price target from Facebook to 36.1 from 277, which is happening right now. 36.10 is not around the corner. So the thing is this, Credit Suisse, well, you should use this one to save yourself, you should buy all into this Meta, make the money, and then pay off your debt. What do you think? All right, last but not least is Apple. Now, Apple have been doing sideways movement. We also know that Apple went down to the low of this $84 back in November, and then now it's back to $325. Honestly, it's not the biggest recovery, but it's still one of the highly watched counter. So Credit Suisse have just raised the Google price from 150 to 135 to 150. All right, so it's not too far away, and they maintain its outperforming rating. So once again, Google and Apple, same thing. Yeah. So what is happening right now is that Credit Suisse believe that it will go higher. So Credit Suisse have given two views. Hopefully, they should invest it more so that they can get themselves off the current situation. All right, that will be all for today. I hope you enjoyed this video. There's one more video coming out later, and that will be the CNN Fear and Greed Index. Kel signing off. Bye-bye.